Good morning, everybody. Mike Vacchi, PrincetonTrader.com here for NTMarkets.com with your Tuesday morning pre-market webcast. Okay, S&P 500 E-mini futures daily chart, and it's not much different than what we discussed yesterday. We had resistance in the area of the second standard deviation lower band that kept us down here in the channel, which is what I call the space between the second standard deviation and third standard deviation, in this case lower band, okay, for a third, going on a fourth day. It's been a pretty wild night. We had trouble at the end of RTH getting through the 20 to 23 area. We've moved down as low as 1900, and we've traded off of that as high as 30 to 30 and change. So we've done 20 down and 30 up in the overnight. And what's that indicative of? It's that this is bear tape stuff. This is bear market stuff. Now, whether on a long-term basis, on a on a macro basis, we're in a bear market, that's not for us to figure out. It doesn't really matter. What we need to understand is that until the bulls do some serious, soul searching and figure out that they're able to hold some lows and build up higher lows and move up above that mid band, we are in one way, shape, or form, depending on your time frame, in sell rallies mode. We've taken the market every day up to a high, and that high has been violently sold down to make a new low. And just when you think they can't do it again, that's exactly what they do. So, I mean, this market's got all the volatility that you could ever ask for as a trader. But you've got to, you got to keep it in perspective. Take your profits when you have them. As we get longer in the tooth on this band ride, you've got two very wounded sides, okay? Well, the bears are getting a little more wounded as we go because these rallies are so hard to hold and they run so far. The shorts at this point have gotten way more out of this than they ever thought they would. I mean, if you take it to where we were 2 Sunday nights ago, we were talking about 37 to 47, and I was talking about the loss of this cluster of moving averages and pivots and the like, creating a band ride without tight bands, which is what we had. They've gotten much more out of this than they had anticipated, and they're starting to get nervous. You can tell in the tape. They're starting to get nervous. They're thinking every tick's the last tick, and that is lighting the fire on these bear market rallies. The bulls, on the other hand, have been bludgeoned, and they're a bunch of wounded animals, and it doesn't take much to spook them and drive the market down to new lows. So you've got two sides that are really just violently, fighting over this area between, 1898 to 1930. Frankly, I'm pretty surprised that we're not solidly in the 1800s at this point. Back in August, when we broke 2000, we moved through the 1900s very quickly and got into something with an 18 in front of it very fast as a byproduct, personally, I think, of fear. We started that process this time around, but we've paused as we've gotten down and started to probe into that 1800 area. Now, it's a long day. There's a lot of day left. And they've probed into it once, and they may go back and see it again. And if the dynamic of this market holds, what you're going to see is, some point this afternoon, you're going to see new lows. The clue, the shot across the bow, so to speak, that the bulls can put together a multi-day rally, which I think they're absolutely capable of doing, and I continue to maintain that the weekly pivot of 1954.60 is going to get hit this week. The question is, from how many sold rallies is it going to take before we get the one that's going to work? And you can lose a lot of money screwing around with that, so be careful. The dynamic that the bulls have to break is to make those lows, get into the 1800s, and stay there. If that happens, they can continue to extend things. The problem at this point is the Bollinger Bands are at 9.77 as I speak. They're not completely blown out, but they're really getting there. the ability to maintain price in between the Bollinger Bands, and I mentioned this yesterday, it's not really a function of price, it's a function of time, it's a function of the bands expanding. That time's pretty much past. If they're able to keep it between the second and third standard deviation bands today, it's gonna take more and more effort every day for the bears to do that. So that lends itself to, a rally that runs longer than a couple of hours. Um, Ultimately, though, I very firmly believe that those rallies are going to be sells. Um, but in in seeking out that multi-day rally, um, you've got to control your size. You got to use stops. You got to be smart. Okay, and if you're a short and you want and you want to sell the rallies, you really got to wait for some lower highs. You got to wait for some confirmation. You may miss 4 or 5 handles, but we're talking about 25, 30 handle rallies. You can't be greedy. The cost of being greedy is you get in early and you get drug. They drag you by the back of the truck for a few miles. You let go of the rope, and then they take the market down. All right, everybody have a great day. Follow us on Twitter at Princeton Trader. Check out the website. Check out the chat room. I'll be back tomorrow morning with another webcast. Trade them well, everybody.